Hi guys. Today we will analyze DuPont stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. Also recent evolutions are not positive. The short-term trend is negative, the long-term trend is negative. There should be more interesting stocks out there. Strong support levels are around $54 and $51. Next strong support level is around $38. Strong resistance levels are around $63 and $69. Next strong resistance levels are around $75 and $85. In the last month the stock has been trading between $52.60 and $67.60 range. It is currently trading near the lows of this range. The stock has an average volume of 3.4 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around -1% per year, for last 5 years. We see that the average profit margin of the stock has been around -1% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 173% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for DuPont Company: bad, average, and good. First scenario. DuPont will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 3%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $21. Second scenario. DuPont will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $29. Third scenario. DuPont will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 5%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $39. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.01. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For DuPont, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for DuPont Company: bad, average, and good. First scenario. DuPont will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future P/E would be a low, 14. In this case, the fair value of the stock today would be $25. Second scenario. DuPont will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 16. In this case, the fair value of the stock today would be $32. Third scenario. DuPont will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 18. In this case, the fair value of the stock today would be $39. As you can see, today the stock is overvalued, $55, even if we expect the company's high performance in future. Both the profitability and the financial health of DuPont are neutral. Nothing too spectacular is happening here. DuPont has had very volatile earnings and free cash flow since 2018. Also, the stock is expected to show a small growth in revenue in the next 5 years, 4 to 6% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since January 2022, and it can go lower, before it recovers. I may consider buying the stock for the dividend, when the stock drops below $40. Company's strengths. DuPont de Nemours is a leading specialty chemicals company, formerly known as DowDuPont, and operates through 2 business segments. The Electronics and Industrial segment supplies materials and printing systems to the advanced printing industry and materials and solutions for the fabrication of semiconductors and integrated circuits. The Water and Protection segment provides engineered products and integrated systems for worker safety, water purification and separation, transportation, energy, medical packaging and building materials. Prior to the spin-off in 2017, it was the world's largest chemical company in terms of sales. DuPont's transformation into a business with more exposure to markets with secular growth trends, electric vehicles, clean energy, water sustainability, hinges on successful mergers and acquisitions integration. DuPont's specialty chemicals business is among the best in the world, developing products such as Kevlar and Tyvek, that command pricing power and generate healthy profit margins. The electronics and industrial business is well positioned to increase profits, as a result of growing demand for semiconductors and increased connectivity from 5G and Internet of Things technologies. DuPont's profit margin of 10% and return on assets of 3.4% are comparable to the industry average. Risks. DuPont is still facing pressure from the semiconductor shortage. The company faces stiff competition. The firm operates in many highly cyclical end markets, including automotive, residential construction, and electronics. DuPont could see a prolonged slowdown in demand in any of these markets. In addition, there is no guarantee that DuPont's investments in specialty chemical R&D will yield positive results. If DuPont is unable to develop new products to replace formulas that roll off patent, develop new uses for its products as patents expire, or if its new products fail to generate the same incremental demand growth from its end users, its ability to charge a premium for its products would deteriorate. As a chemicals company, DuPont also faces risks related to future potential new regulations. These could include product bans, emissions caps, or the risk of additional environmental remediation. DuPont has a return on equity of 6%. This is below the industry average of 17%. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 4 to 6% on average per year. The earnings per share is expected to grow by 6% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.